With the advent of the early modern period, we saw some evolution in terms of the structure of banking, and in some cases, in the way that these kinds of institutions were governed. During the late Renaissance and early modern period, we see the beginnings of goldsmith bankers emerging in England. This had originally happened as a result of realizing that the concentration of wealth in the royal vaults could lead to the possibility of expropriation by the sovereign. This actually happened in England in 1640. Prior to that, a number of people had been willing to make deposits in the royal treasury under the expectation that there was no safer place in the entire British Isles. However, the king, Charles I, used this as an opportunity to create a forced loan of these depositors to himself. And unsurprisingly, the depositors were less than impressed. So after this period, what we start to see is that money begins to move into deposits at goldsmiths, who, like any other kind of person who works with precious metals, obviously has some security to ensure that the raw materials that they're hoping to turn into jewelry or materials that they're essaying for others would be safeguarded. Now, of course, the goldsmiths were happy to keep other people's gold under lock and key for a fee, as is traditional in any kind of banking relationship. But they also made loans with these sorts of deposits, tended to act as currency converters for people who wanted to exchange one for another, and even dealt in bills of exchange. So they started to be originally as a vaulting service, but very quickly developed into what we would call the sort of traditional aspects of banking, borrowing gold effectively by taking deposits and then using that to underwrite loans and other standard banking functions. Now, interestingly enough, despite the fact that people moved towards holding a lot more of their gold in goldsmith banks, what the end result was is that the gold did not stay with the goldsmiths. Instead, the gold was lent right back to the royal treasury. And this created some serious problems. Just 32 years after Charles I's forced loan, we encounter what's called the stop of the exchequer, in which case the government stops servicing its loans or its debts to these goldsmiths. So once again, government financial problems still came home to roost. And it shows us that relying on goldsmith bankers doesn't really solve the problem if the goldsmiths are simply going to lend our money back to the same root difficulty in the first place. But there are other important evolutions that happen. When we start to move into the Industrial Revolution, we see that in addition to large money center banks that we see generally in capital cities, we start to see the emergence of what we call country banks. And these country banks were following the same sort of pattern that the Italian bankers had during the early Renaissance, which is that there was some kind of industrial or trade-based operation that required financing, and banking became a system for raising that capital. So effectively what we had were captive banking institutions under things like the Medici or Bardi or Peruzzi families, and this reemerges in England in the late 1700s. In around 1775, we have approximately 100 of these industrial country banks, but just 35 years later, in 1810, there are over 800 of them. So these bankers typically these organizations created their own banks rather, because they had difficulties borrowing in sufficient capacities from the large money center banks, who tended to spend less money developing local industry and tended to spend a lot more of their investment capital on developing emerging economies that were part of the British Empire. These were seen as providing higher yields, and so to some extent, the money center banks were actually channeling British savings out of Britain. Meanwhile, the industrial banks were hoping to use British savings to finance a British industrialization. It's worth noting by about mid-19th century, roughly a quarter of all of the circulating currency in Great Britain has been issued by these industrial banks. So we see a real challenge emerging among smaller competitors towards the notion of dominance by the money center banks, in this case, the Bank of England. And we actually see that by 1844, the Bank of England takes itself out of commercial competition with these various kinds of banks. And there's a major restructuring of the British banking system in that year. But another important innovation happens around the same time. In the early 1800s, Scottish minister Henry Duncan opened up what was called the Ruthwell Savings Bank, where they accepted deposits of as little as £1 and offered interest rates that increased the longer the term of your deposit. The objective of the Ruthwell Savings Bank was to try to provide some kind of financial security among the poor and to encourage this idea of saving to be able to safeguard one's own financial future as opposed to necessarily spending everything and then relying on charities once there were problems. Now, all of the deposits were not lent out into commercial loans or used for working capital financing, or and instead were lent to the government. They were invested only in collateralized government bonds. And this afforded some measure of protection, even though it may not have offered a particularly high rate of interest. The objective here was not to maximize the value of people's earnings so much as to offer them a opportunity to put their small savings into a relatively safe investment. It took a little while for the idea to catch on, but within a year, they had 151 pounds worth of deposits, and within 4 years, they'd reached 1,100 pounds worth of deposits. The year after that, by 1815, the idea had clearly spread very widely, and almost every single town in Scotland had its own individual savings bank. By 1818, there are over 450 savings banks operating across the British Isles. So there was clearly a very substantial demand among these underbanked communities with an opportunity to not only generate savings, but to put those savings to work in some way that might enable them to earn some rate of return. Now, we do see some international descendants of this very quickly. By 1817, the Wickham, and by the following year, the Rotterdam Savings Bank begin to emerge based on translations of Duncan's work that had reached the Netherlands. So this idea traveled very, very quickly, and in fact saw yet another stage of evolution with the creation of credit unions or banking cooperatives in the 1860s. The short version of the story of the credit union is that throughout roughly a 100-year period between 1750 and 1850, the various serfs and peasants of Europe were emancipated from their feudal lords, and this meant a significant change in the economics of being a farmer. Under feudalism, I'm allowed to keep what I need to survive, but any of the surplus I generate is taken by my lord. So there was never any need for the poorer ranks of society to have financial institutions because they generated no surplus that they allocated themselves. Banking was important for the rich because they harvested this surplus and then needed somewhere to put it to productive use. But the problem with this, of course, emerges once farmers do generate their own surpluses. Yes, there are opportunities like the Ruthwell Savings Bank to be able to put some of these surpluses to use, but there wasn't a lot of opportunities to extend credit to these same farmer class when they ran into trouble. So rather than submitting all of their savings to a large bank, which would in turn not lend their money back to them, German villagers began to experiment with banking co-ops, effectively providing a pool of their own surplus that they would then lend out to one another, effectively forming a credit union. This allowed them to sidestep some of the problems of small loans that traditional bankers tended to ignore, and allowed them to exploit the affiliation that came with living in the same village. Most people were much more likely to default on credit, what were seen as being rich creditors from the city, and a lot less likely to default on the farmer who lived across the road from them. So credit unions caught on very, very quickly, quite frankly. If we take a look around the world today, in the last 150, 160 years, we've seen credit unions spread to the point where there are over 200 million members of credit unions around the world. In Canada, they're particularly important, quite popular in the province of Quebec and in Saskatchewan, and credit unions are wildly popular in modern Germany. Now, credit unions are typically organized on a non-profit basis. They are still charging interest rates and they are still charging fees, but any of the money that they make is in fact returned to all the members of the cooperative. And the cooperative typically won't accept deposits from people who aren't members and won't extend loans to people who aren't members. So effectively, any surplus that's generated by the organization that we all participate in, and strictly speaking, we all govern, is returned to us. And this enables a group of affiliates to keep their capital flowing within their own communities. So perhaps it's unsurprising that if you were to walk through downtown Toronto, you would see credit unions affiliated with different religious organizations, different ethnicities, and sometimes you'll even see credit unions built around having a common employer. Just like a bank, a credit union maintains a capital buffer to protect depositors against the possibility of default. but these are generally regulated in slightly different ways than our larger traditional banks are. Nonetheless, it's important for us to understand the nature of credit unions, how they work, because they are become much more popular in the 20th and 21st centuries, particularly as people seek out further dimensions of affiliation